Hey, Brandon.
Hey, Todd. How you doing?
Good. How's it going?
Good.
We appreciate you being on our show.
Absolutely. Thanks for having me on.
And I tell you what, I mean, there's a lot going on right now with the current administration. We're going to talk about tax laws, and I'm excited to dive in with that. I've been a real estate investor for over 25 years. I've been serving the housing market as a contractor for 30 plus years. Hard to believe. But it's amazing to me when I'm helping investors sell properties and I ask them things like, how long they've depreciated their asset. Most of them have no idea what I'm talking about. I mean, they buy houses, they move out, they rent, and they just never do it right. They don't ask the right questions. I guess they're accountants. Not all accountants are treated equally.
That I can agree with. Yeah.
So it's amazing. I mean, this is your expertise, and we're really excited to have you with us this evening.
Well, I'm excited to be here.
So anyway, guys, if you're just tuning in, thanks for watching another Tuesday night podcast. I'm Todd Sachs. I'm a broker here in Maryland. We serve both residential and commercial real estate clients, no matter whether they're selling, buying, renting, landlording. We kind of do it all here in Maryland. But if you're anywhere else in the country and you need great real estate assistance, shoot me a line, just drop me a text or a comment, email me, call me. I'll be glad to point you in the right direction to a rock star in your town. But tonight, guys, we have Brandon Hall. Really excited. Brandon is a CPA, and he specializes in real estate tax law clients. That's what he does for a living. He has an amazing business serving the entire country. Brandon, thanks again for joining us. Go ahead and tell everybody a little bit about you.
Thanks, Todd. Yeah. So I'm a CPA. I run a CPA firm called the Real Estate CPA. We service around 700 clients across the United States, and every single one of them is in real estate. I have a team of 21 staff. We're actually in the middle of hiring 8 additional by the end of the year, so growing pretty rapidly. But yeah, we provide tax planning, tax compliance, and accounting services to landlords, real estate investors all over the U.S., sometimes international. There's just a lack of solid understanding of tax knowledge in the tax preparation, tax advisor space. So we kind of fill that gap. We work with really large clients, and then we also have kind of educational things for smaller landlords who are just trying to get started.
So, Brandon, why real estate? I mean, when you decided to be a CPA, I mean, you said that there's this big need for it, but besides that, I mean, did you come from a family of real estate investors? I mean, do you invest yourself? I mean, what kind of pointed you in that real estate market?
Yeah, when I was in college, I audited a graduate level real estate class and convinced my parents that they should invest in real estate, kind of like a capital free case study for me. So they started investing in real estate, and then I went on to, after college, went on to work at PwC and Ernst & Young, 2 large accounting firms. And through my time there, just started like I was on Bigger Pockets, a real estate forum, and I was answering tax questions and just sort of started taking on clients left and right. At the end of the day, though, what I was really trying to do is understand, like, I wanted to invest in real estate myself. So I wanted to understand, does real estate legitimately build wealth? So if I prepared people's taxes, I figured I'd be able to find that out. And it turns out real estate does build pretty significant wealth. I am a real estate investor myself. I have 25 units, a lot of small multifamily properties, and then a short-term rental at the beach, which is our newest one, which is a lot of fun. But yeah. So we're very, very heavily involved, and it's actually something that I could say about my team too. Between the 21 of us, we have, I think, 200 plus units or so. So we invest in real estate too, and it's kind of nice for our clients. I think that it's something that allows them to not just talk taxes, but integrate that with actual real estate investing experience.
A lot of real estate investors have jobs, full-time jobs where they're getting a W-2. And a lot of times, being a business owner myself, a lot of what we do being self-employed, some of the maybe only benefits are the tax benefits. I mean, it's so hard to make money, as you know. And when you do make a profit, and when you have a rental property or multiple rental properties, you're self-employed, as far as that, that property or that aspect of your life. And you want to take advantage of the legal, and I do say that, legal deductions, make sure that you're taking what you can, right? I mean, that's why, it's important to have a good advisor like yourself. But like I said, I see so many times, and for years, look, I put myself into that category. I've been in the business for 30 plus years, serving the industry in one way or another, the residential market, housing market. But for the longest time, I didn't do it right. And I felt, and even still today, I feel that I have to guide my own accountant, along the process and discover a lot of these things myself, which isn't right. I mean, it's clearly, you want good advice. You want somebody that's able to help you. But, it is a specialty. So we have a new administration, the Biden administration. There's been a lot of controversy. So can you just kind of take us from the top, what is the significance as it pertains to the new laws?
Yeah. So at the beginning of the year, President Biden proposed a whole slew of tax changes, some of which freaked real estate investors out. They wanted to get rid of or significantly reduce the 1031 exchange. They wanted to increase long-term capital gain rates to, I believe, 39.6%. And they wanted to limit or remove the stepped-up basis rules. So stepped-up basis is, my 25 property or my 25 units that I own. If I were to die and pass those on to my son would inherit them at a basis equal to the fair market value of the property. So the appraised value of the property on the date of my death, that becomes my son's basis. And that's significant because the way that you calculate tax gain is you take your sales price minus your basis, and that's the gain that you pay tax on. So if my son inherits it at the value that we could sell it at today or when I die, and that becomes his basis, then his gain is $0. He doesn't pay tax on that. So they wanted to get rid of the stepped up basis and basically say you inherit your parents' basis in the asset. So if I bought the asset for $100,000 and then over 15 years I depreciated it by $40,000, my basis is $60,000. Well, if I die and the property is now worth $300,000, then my gain is $300,000 minus my basis of 60, and that's a $240K gain that I would have to pay tax on, or that my son would have to pay tax on if they got rid of these rules. So those three items, 1031 exchanges, long-term capital gains, and stepped up basis, really wigged a lot of real estate investors out and had us kind of thinking, all right, what are we going to do? But we told all of our clients, look, we have to see how this is going to play out. We don't even know. Like, I don't want to go start making changes. And we had clients that unfortunately sold assets because they thought that this long-term capital gain tax rate was going to be retroactive, and they wanted to beat the deadline. And I say unfortunately because in the most recent bill that has been proposed, there's nothing about any of those three things in the bill. And that's why we always tell people to wait, to just hang out, hold on, and just see what actually gets passed. So the Democratic Party this year has been plagued by infighting. They have a very small majority. So every single one of them has to vote yes. That's in the House and the Senate. Every single Democratic congressman or woman has to vote yes on this budget reconciliation bill that you've seen in the news. And the problem is that you have progressives that are way left that want a lot of social spending, and they want to raise a lot of taxes. They want the wealth tax on the billionaires. They want all the tax revenue, right? But then you have the moderates on the other side that sometimes could be Republican, and they don't want all the social spending. They don't want to raise taxes on corporations and individuals. And the problem is everybody has veto power, because if one person says no, the entire bill is tanked. And that's why you've seen all of this news about the Democratic infighting, the trying to get some sort of deal together that makes sense. In October, they proposed a deal that had a lot of retroactive tax increases, like syndicated conservation easements going back to 2016, disallowing those. IRA investments, if you were using like a self-directed IRA to invest in a syndication, that would have to be cashed out and distributed from your IRA and taxed. There was a lot of that type of stuff. They raised the individual tax rate, did a whole bunch of things, but everybody, again, the parties on both sides started warring each other. And at the end of the day, if one person says no, then you have to go back to the table and rewrite the bill. And that's exactly what happened. So now we have a bill that came out last week, end of October, and it's pretty vanilla. I mean, it doesn't have a whole lot that real estate investors should be worried about. I mean, there's a 15% alternative minimum tax for corporations. There's a 3.8% net investment income tax. And that's really if you're just running an S corporation. So if you're like a real estate agent listening to this and you're running an S corporation, normally we run S corporations to avoid self-employment taxes, right? So we'll pay ourselves, if I net 200K of W-2 earnings and I don't run an S corporation, then the entire $200,000 is subject to self-employment taxes, which can be up to 15.3%. So pretty significant tax. So you run an S corporation to pay yourself of that 200K net income, you pay yourself a W-2 wage, and only the W-2 wage portion is subject to the self-employment tax. But what this administration is doing in this recent bill is they're adding the Medicare piece of the self-employment taxes, the 3.8% tax. They're going to tax every single dollar that you earn, regardless of how you pay yourself out. So that's a change for S corporation owners to know and understand. We've got wash sale rules for cryptocurrency now, so treating those more like stock and options and futures. But nothing really crazy. I mean, they wanted to do the billionaire wealth tax, but they stripped that out at the last minute because it was going to be too expensive or too complicated to run. So instead of that, they added a multimillionaire surtax. I mean, you've got to be earning like tens of millions of dollars to be subject to it. And probably the most significant thing that real estate investors should be worried about is just Irs Audit Enforcement. So they're funding the IRS in a pretty significant way, or they're appropriating money to the IRS in a pretty significant way, and they're allocating, I think it was $44 billion or $45 billion to the IRS specifically for enforcement. The IRS has to come up with a plan on how they're going to use the money. So maybe that comes out mid-year or Q1, Q2 of next year. And then you start seeing audits increase Q3 or Q4 of next year. So that's probably the most significant change in this bill. And any of our clients that are asking us about it, we're just saying, hey, go back and make sure that your documentation's rock solid. All your T's are crossed, your I's are dotted. But even still, we don't know if this one's going to pass. I mean, this yesterday evening, Manchin decided that he didn't like aspects of the bill, and so now they're going back to the drawing board again. So I don't know if anything is ever going to pass, honestly. I mean, there's a good chance that nothing's going to pass ever, because they only have until really the end of this year. Because once they start going through primaries again, if they lose that majority, it's all over, right? So what they're doing is they're using the budget reconciliation process to pass this legislation. They're trying to force this through, but you have to have a majority in order to do that. And they have a very slim majority. So if they lose one seat in the upcoming elections, then it's all over.
Is there any portion of this that could be an executive order where they could just rule it in?
No, not that I'm aware of.
You talk about real estate investors freaking out a little bit. I was certainly one of those. I had a significant gain on one of my properties that I had sold this year, and was attempting to do a 1031, but that in itself is not easy. I mean, it's sent the money out to the intermediary. The way that it's structured, you have to identify these properties, and it wasn't easy. It didn't end up working out. So I was really stressed out about it. And finally, my accountant said, look, just pay the liability. And we don't have a choice, right? When you talk about, so a lot of when you're discussing these bills and you're talking about them being retro, there's another term. Is that the same kind of thing as like what I hear people say as a clawback?
Yeah, you could use the words interchangeably. Yeah, I mean, really what's going on is it's just retroactively changing the tax law to create revenue. And the constitutionality of that is somewhat mixed. I mean, they have had retroactive taxes in the past that have been upheld under Supreme Court challenges. So, it depends on how far you're going back. It depends on how much notice taxpayers were given. But yeah, I mean, you could, in theory, go back multiple years with a retroactive tax and tax constituents.
It's crazy. I mean, it just doesn't, I mean, look, that doesn't seem right, right? I mean, to me, that doesn't seem right. And when you're talking about, the stepped up basis, so if something were to happen to somebody in that situation, and we were talking about a taxable gain of $240,000, upon somebody's death and their child or whoever gaining this property, when do they pay? I mean, they have to pay that right away, right? I mean, is that something that is due right away?
Well, I mean, they would file a tax return and then have to pay it. So they would have, depending on the date of death, they would have some time. But the problem is probate can hold up a lot of these assets, and so you can end up with tax bills that you struggle to pay as a result. So it just kind of depends on how the estate is set up. But yeah, I mean, you owe that tax. If they do away with that stepped up basis, you would owe that tax relatively immediately.
So when will we know if any of these laws are actually going to pass?
Well, I don't know. I mean, I would hope by the end of the year. I think by the end of the year we're going to know one way or the other. But I was telling people that we would already know by now. So I don't know. I mean, the bill that was proposed last week, like I said, looked pretty vanilla. But now you've got congressmen that decides, no, I don't like this. It's too much money, and we're raising taxes in the wrong way. So now it's potentially back to the drawing board, right? If they can't convince him to get on board. And if you tank a relationship with anybody in the Democratic Party, then they're just going to vote no matter what. So that could happen. So I don't know. I mean, I would say by the end of the year, we'll know for sure, which probably isn't very helpful for people that are going through tax planning right now, but that's the reality of it.
So when you talk about this new IRS bill that is, putting $44 billion that could potentially go into enforcement, is that specifically for real estate investors, or that's just kind of across the board enforcement?
Yeah, so we don't know yet, right? So the way that it works is they appropriate money to the IRS, and the IRS has to come up with a plan on how they're going to use the funds. So first, we have to vote the bill in so that the appropriations actually happen, and then the IRS comes up with a plan. So I don't know how they would use the money, but right now you can just think of it across the board enforcement. Now they would most certainly, they're investing too, right? Like Congress is investing too. They're going to appropriate $45 billion to the IRS, and the expectation is that they're going to raise $400 billion in unpaid taxes from this additional enforcement. So this is an investment for them too. So, if you're a real estate investor, you obviously don't want to invest in a bad asset, right? You would invest in a good asset. And the same thing can be said for the IRS. They're not going to go and spend a whole bunch of time and money in places that they know they're not going to raise a whole bunch of revenue. They will go spend a whole bunch of time and money in areas that they know that they can raise a bunch of revenue. So yeah, if I'm investing in real estate and I'm creating large tax losses, and I'm taking those tax losses against my ordinary income, like my W-2 income, business income, interest, dividends, capital gains, stock sale, whatever, then yeah, I would expect to potentially be a target of this increased enforcement.
Interesting. So how does somebody prepare you? I mean, obviously, documentation is the key. is there one thing that, in your experience that triggers this type of activity? You had mentioned losses or something like that. I mean, does it matter how the entity is structured, whether it's just a sole proprietorship in somebody's name, or do they look more specifically for these S corps or LLCs?
No. So historically, audit rates are lower for partnerships and S corps than they are individuals. But all that's historic, right? So everything that the IRS has done in the past might not matter if they get $45 billion of increased funding. They might change how they pick people for audit, and they might change their red flags. The IRS has a computer program. Whenever you e-file, it just goes into their computer program, and they run algorithms against your information that you give them to determine what, basically, like, give you an audit score. Should we audit you, or should we not audit you, or should we send this to somebody that's going to manually look through your file? We see audits. I think, I don't have any data for this. There's nothing out there statistically that I can point to. I think audits are higher for real estate investors than they are, a regular old W-2 person. And that makes sense, because if you've got a bunch of rental properties and you're running a business, there's a lot of different ways that you can make money disappear. I'm not advocating for that, but that's what the IRS is thinking too. So they're going to go pull your files a little bit more frequently than they are somebody that just gets a W-2 wage. But yeah, I mean, I would, we have been living in an era where nobody's really scared of the IRS because they've been underfunded. They're overworked. They're not, audit rates have been at all-time lows. So, like, as a populace, we're not scared of the IRS. But if they get this additional funding, and if that trend continues, historically, if you go way back, people have been scared of the IRS.
It used to be mean.
Yeah, it's not something that you mess around with, and we might start going back toward that direction. And that's not, honestly, it's not totally a bad thing. You're going to catch your tax cheats. You're going to catch people that are engaging in actual tax evasion, that are paying their contractors in cash or receiving money in cash. I love talking to contractors because, I don't fill out W-9s because then I get a 1099 and I have to pay tax on the income. What you're saying is you're a tax cheat. That's what you're saying. So you're engaging in tax evasion. Those people should get caught. Hey, everybody's got to pay taxes. It's a part of life. But Absolutely. If you're doing things legitimately, like, I buy a rental property, I cost segregate it, I get bonus depreciation, it creates a large tax loss. I understand the passive activity loss rules. So I know that I can use this tax loss against my other income because I know how to work the passive activity loss rules. You might get audited, but you'll win that audit. And that's the difference. So I think that we're going to start, if this passes, we're going to move towards that. Everybody's getting a little bit more nervous about the IRS, and for good reason. We should be a little bit nervous. That's the ultimate accountability check.
There are things, though, I know, like my accountant has guided me through, that where a lot of people go wrong is they try and deduct everything, that year that they write that expense. And there's if you have a rental property and you're doing capital improvements to it, putting on a new roof, a lot of times your tendency would be, hey, I want to write that off right now against any gains that I have. And it may not be that, right? It may be an improvement that's depreciated versus something that you say is a repair or a typical maintenance. And I've had them call me up and say, question it, like, hey, this amount that you're writing off here, what is it in more in detail? And then I'll tell them, and they'll say, nah, you can't do that. You have to, we have to depreciate that as an improvement. So, and again, we're talking to Brandon. Brandon is a CPA, so he can talk about this stuff where I can't, right? I don't know what I'm talking about. I'm a real estate broker. But Brandon, I'm sure you're open to business, right? If anybody's out there listening right now and they, are real estate investors and they feel that they could maybe be served better by somebody who specializes in this, we're publishing all of Brandon's information and show notes. Feel free to reach out. Brandon, you're in all 50 states. Is that correct?
Yeah.
Okay. And, because real estate is trending right now and you have so many people investing or, that may be able to keep the property that they are living in as a rental and they're moving on. There are certainly different implications and different strategies based on whether you're flipping real estate, buying something for a short-term hold and flipping that property, or landlording and investing. Are there just some quick, tips that you could say or strategies that people want to think about when they're doing one versus the other?
Sure. Yeah. So when you're investing in real estate, a lot of people get into real estate. A lot of people get into real estate for the tax benefits. And then the rest of the people get into real estate to make money, build wealth, and then they learn about the tax benefits. So eventually you're learning about the tax benefits, but it's really important to understand that you don't really get tax benefits unless you're buying rental real estate. And I know that might seem odd to say, but you really don't. Because if you're flipping properties, if you're building, if you're developing, there are certainly ways that you can mitigate taxation, but we're talking about it from a business perspective, like you would be running a CPA firm or a law firm or a dental practice or an Amazon wholesale company. Now we're just in business taxation. And so it's a little bit different. So the real tax benefits come from owning rental real estate. And the reason for that is if I buy a property and it cash flows $10,000 a year, but my depreciation expense is $11,000 a year, then I have $10,000 of cash flow that hit my pocket, but my depreciation expense allows me to tell the IRS that I actually lost $1,000. That's how you accumulate wealth quickly in real estate without paying tax on the cash flow. Because if I can 10x that, now I'm getting $100,000 of cash flow that's hitting my pocket every single year. But I'm telling the IRS that my depreciation expense was $110,000. So I'm telling the IRS that I lost $10,000 from a taxable income perspective. And depreciation, the whole thing about depreciation, so depreciation is meant to track the deterioration of your asset over time. So a lot of people get confused because they go, "Oh, wait, real estate appreciates. Why are we talking about depreciation?" You're right. The value of real estate appreciates, but the building itself literally falls apart, right? Nobody can argue that. So that's what depreciation is meant to track. It's basically an annual credit that you get that is meant to track the deterioration of your building and of your components. And so a lot of the tax planning, if you really want to maximize your tax savings, you work with an accountant or you read a bunch. If you're a self-study person, that's fine too. But you figure out how to maximize your depreciation expense in any given year, because that's going to create that tax loss that we were just talking about. Even though I have positive $10,000 of cash flow hitting my pocket, cold hard cash that I can go take to the grocery store and buy a whole bunch of stuff with. Even though I have that cold hard cash, I'm telling the IRS that I lost $1,000 because my depreciation expense was $11,000. So I'm doing things with my depreciation to exceed my cash flow, and then I have this tax loss. So then the next question becomes, can I use the tax loss against my, say, flipping income, right? Or my development income or my CPA firm income? And that's when you get into the passive activity loss rules and figuring out, okay, how do I move this tax loss into the appropriate income bucket so that I can offset my other income? And that becomes challenging to do. And that's where we spend a lot of our time tax planning. But if you're on the flipping side, the developer side, there are things that you can do. If you're raising capital to do this development, you can get a carried interest, which is subject to lower tax rates than like getting paid a guaranteed payment or any sort of ordinary income. But a lot of times on the flipping, building, development side, we're helping with entity structure. We're helping understand the timing of your expenditures. You can always prepay expenditures. And we're just helping you understand your options to help run your business better, right? Like people always think of buying a heavy car or truck and writing that off. And that's certainly a viable strategy. But the first thing that we always ask is, how is this going to help your business? Do you actually need a new truck? Because this is an asset that literally loses value. You don't depreciate it and then it appreciates in value. You depreciate it and it actually depreciates in value. So do you actually need this new truck? And so we do a lot of that type of education just to help people understand what they can and cannot do.
And that's very well said. I mean, as a someone who's holding property as a rental, there's sort of like different strategies within that as well, because as you're depreciating this, there's a certain amount of time that you have to own that asset, because when you sell it, if you haven't waited that amount of time, then what you've depreciated actually gets added back in. Is there any way around that? And can you talk about the time frames and the sort of the thought process if you are depreciating these rental assets? Should they be thinking about keeping them forever? Should that be their strategy?
Yeah. So great question. So let me explain the concept first, and then I'll answer the latter of should you hold forever or not. So what you're talking about is something called depreciation recapture. Now, depreciation recapture occurs when you claim depreciation on a building and then you go and sell that building. Depreciation recapture is really just kind of talking about the gain on sale that comes from the depreciation that you've claimed previously. Now, that might sound confusing, but I think that this example is going to help you. So let's say I buy a $100,000 property and I depreciate it $40,000 over the hold period. We used this example earlier in this talk as well. So I bought a property for $100K. I depreciate it $40,000 during however many years I've held it. My adjusted basis is now $60,000. So if I sold the property for $101,000, most people would say, I bought it for $100, I sold it for $101, I have a gain of $1,000. But the problem is that depreciation erodes your basis in the property. It chips away at it, it reduces it. So in this example, because I bought it for $100 and I took $40,000 of depreciation, my adjusted basis is $60,000. So if I turn around and sell it for $101,000, then I take $101,000 minus $60,000. That's my total gain. And that's a $41,000 taxable gain. Now, of the $41,000 taxable gain, $1,000 comes from appreciation, right? That was my 100K purchase price, 101 sales price. So $1,000 comes from appreciation. $40,000 comes from my depreciation. And that makes sense because I took $40,000 of depreciation during the hold period. So the $40,000 of gain coming from depreciation is called depreciation recapture. No matter how long or no matter how long, whether it's like 1,000 years or 2 years or 6 months, or well, not 6 months, but 1 year, I'm always going to have that depreciation gain aspect. So I'm always going to have to recapture depreciation because I've claimed depreciation on the asset and it's moved my adjusted basis down. So you've always got depreciation recapture. Now, depreciation recapture can come in a multitude of different tax rates. Most people think depreciation recapture as a maximum 25% tax rate, and that's generally true. But if you've taken bonus depreciation on any components within the asset, then you could be looking at your top tax rate of 37%, at least today. So you got to be aware of what that recapture tax might look like. So just important to understand that any depreciation that you claim today, it's a tax benefit that you get today, but at some future point, you're going to pay that back. And you're going to pay that back when you sell the property because you're going to have increased gain on sale because your adjusted basis is lower than what you actually bought it for because you depreciated it. Now, should you depreciate the property then, knowing that? Yeah, absolutely. How long should you hold it? It doesn't really matter. Well, I mean, it does matter. It kind of depends on your investment strategy, but I wouldn't let taxes drive that decision. So let's talk about should you depreciate it at all? Because we get that question every once in a while when people think that they go, oh my gosh, I don't want to owe all that tax in 10 years. And what I like to talk about is the time value of money. So if I go to the grocery store today and I have a $1 bill in my pocket, and I go back to the milk section and I see a half gallon of milk for $1. And I pull that $1 bill out of my pocket and I say, okay, I can buy this milk. Then for whatever reason, I say, I'm not going to, I'm going to wait. So I put it back in my pocket. A year goes by. I forgot about that $1. I've washed my jeans multiple times at this point. But now a year goes by and I'm going back to the store. This time I'm going to go buy the half gallon of milk. I really need it for whatever reason. So I go back to the back of the store, look at the half gallon of milk, and I put my hand in my pocket, and sure, lo and behold, there's that dollar. So I pull my dollar bill out. Cool. I have $1 and I can buy this half gallon of milk. And then I look at the prices of the half gallon of milk, and now it's $1.03. Okay. Now what happened here? Well, inflation, the price of goods goes up over time. But what's also happening here is the time value of money theory is playing out. $1 today is worth more than $1 tomorrow. I have the same physical dollar. It's been sitting in my pocket for a year. A year ago, I could have bought the half gallon of milk, but now it's $1.03. And my $1 physical bill that I have I can't buy it with that $1. I have to come up with an additional 3 cents. So that's the time value of money theory. It says $1 today is worth more than $1 tomorrow. So if you apply that theory to your tax bill or your tax savings, then it makes sense to take all of my tax savings today, or as much as I can today. And even if I have to pay them back later, it doesn't matter, because I've taken them today and I've reinvested them today. All right. So I can claim all those tax savings now. I can reinvest them for 10 years, for 20 years, however long I own the asset, and I'll pay them back at some point. But who really cares if my wealth has grown exponentially as a result, and now I'm driving a Ferrari, right? It doesn't matter.
Is there a key to all of this and what you said if you're investing that savings? So does it change your thought if somebody has this rental property and they're never going to own another one, or they're never going to do anything with that money that they would save? Would that change your advice to that person? Would they be better off just, paying the taxable gain, not depreciating it?
Well, so yes, you always have to depreciate your assets. It is a requirement, but you can work to minimize depreciation rather than maximize it. And if you're never going to invest the tax savings, you're never going to do anything with them, you're just going to let them sit in your bank account, then yeah, it's like the time value of money theory that we just talked about. You wouldn't want to, be taxed on this money that you never benefited from, or pay that tax benefit back, but never have used it because your value has eroded over time in the dollars that you've earned, or the tax benefit that you received. But what we have found is that's rarely ever going to be the case, especially in the real estate space. I mean, everybody seemingly wants to build wealth in the real estate space. Everybody in the real estate space, regardless of your background, you're a little bit more entrepreneurial than your W-2 friend at your corporate job, right? Who doesn't care about real estate and will never touch it. And what we find is that those people are more focused on building wealth and will take action to build wealth. And so, yeah, I mean, that's our philosophy, is get all the tax savings back in your pocket as quickly as you can so that you have the capital to reinvest. Now, if you get the tax savings and you go buy the Ferrari, and 5 years later you have to pay it all back, well, then you might have to sell your Ferrari to pay it all back. And that could be a little painful. So you got to be smart with the tax savings. But yeah, if you're going to get those tax savings reinvested, there's really no reason that you shouldn't be maximizing your tax benefits today.
Which is the real point, is make sure you have somebody like yourself that's helping you with your tax planning.
Yeah.
And, that you are focused on investing that, savings that you're depreciating, and not just blowing it or leaving it in the bank. What happens if you die at that point? Is that, so if you're depreciating the asset for 20 years, you pass, how does that affect your heirs of your estate?
Yeah, great question. So let's use that $100,000 example again. So $100,000 property, I've depreciated at $40,000. My adjusted basis is $60,000. Let's say that the property has appreciated to $200,000. So I could sell it today for $200,000. If my adjusted basis is 60, then I have a $140K gain. 40,000 of that's coming from depreciation, like we just kind of went over, and 100,000 of that gain is coming from appreciation, the increase in value. So I've got 140K gain if I sell it today. If I died and passed that on to my son, with today's rules, he would get the adjusted basis, the stepped up basis at fair market value. Yeah. So the adjusted basis goes from 60 to 200. And so now he can sell it for 200, and minus his 200 basis, gain is $0. So it wipes out all your depreciation recapture too. So to your point, if you wanted to hold it forever, you could. And there's actually a strategy called swap until you drop. And what you do is you just 1031 exchange, 1031 exchange, 1031 exchange until you die. Because you can roll over all your depreciation, all of your capital gain in a 1031 exchange. It's kind of like Monopoly, right? You remember Monopoly where you got the little greenhouses, and when you get 4, you can roll them all into a hotel. That's a 1031 exchange. So all of you that play Monopoly know what a 1031 exchange is, whether you recognize it or not. But that you can do the same thing in real estate. So you just keep buying bigger property. You roll the gains over into the new property. You don't pay tax today. And then someday you die and your heirs inherit that property, and they wipe out all that depreciation. They wipe out all the gains because they get it at the basis or at the fair market value.
Now, does that matter? And I know this gets into a little bit more complexity, but does it matter how the ownership is structured as far as if it's a LLC, if the properties are owned in a corporation?
It does. Yes. And the technicalities of that would be probably another 2-hour talk. So the high level summary is never put rental properties in a corporation. If you're going to use any sort of entity structuring, use LLCs. Don't put them in corporations. And when I say corporations, a lot of people think an LLC is a corporation. An LLC is a limited liability company. It's not a corporation. A corporation would be an S corporation or a C corporation. You would want to stay away from those tax designations or those structural setups if you're owning rental real estate. You can run your businesses through them. You can run your real estate businesses through them. Your flipping business, your development business, whatever. But if you have rental real estate, you want to move the rentals out of the corporations, keep them in LLCs.
Would you ever recommend putting them in their personal names?
I mean, from a tax perspective, there's no difference. So a lot of people think that if they put it in an LLC, they all of a sudden get increased business write-offs. That's not how it works. A business deduction is a business deduction, whether or not you pay for it personally or through your business or how the property is owned. It doesn't matter.
So that would really be more of a legal question.
Exactly. Yeah, I was going to say what does matter is the legal protection, and that is a great attorney question.
Yeah, and I know a lot, and the reason I ask that is because a lot of people, they can't, if they need a loan, a lot of banks won't lend to LLCs. I guess you could transfer it later, but there's investor loans that are out there that are great that fix those payments for 30 years at great interest rates. And, but I think there's a max of 10 that a borrower can take advantage of with that program. But there are a lot of benefits of doing that. And, as somebody that has had rentals for quite some time, one of the downsides that I've experienced, because I haven't taken advantage of the investor loans because I always buy them in an LLC, is that, I feel like I'm constantly negotiating with the bank when those notes, come due. Usually it's like a 5, or if you're lucky, you can get a 10-year, note or loan with a 25-year amortization schedule. But there's that balloon payment at the end that if you're not successful in renegotiating, you're back to refinancing, and you may not be successful at that. So there is is there anything that you could add to that? I mean, because that's another thing, right? I mean, that's a big consideration. Have you seen where your clients have been in that situation where, they bought a rental property and they were unable to refinance when that bank loan ballooned, that payment ballooned?
I have not seen it in our client base, but I've heard of horror stories. I think it's more. I think more often than not, you're going to be able to refinance. You're going to be able to find somebody that's going to be able to work with you. You might not necessarily get the terms that you want, but you'll be able to find somebody that will work with you. I think where it becomes an issue is like in down markets and everything's just kind of crazy. That's where you would see a lot of pauses on the refinances. We saw it actually at the beginning of COVID too. Beginning of the pandemic, a lot of banks stopped across the country refinancing for a period of like 3-4 weeks, I think, and that disrupted a lot of financing opportunities.
I had a situation with a client this year that owned investment properties and had sold his business And I guess when you take these loans out, you forget that a lot of times they collateralize the loan based on income, things like that. So he had sold his business, and the bank literally like just took all the money out of his account because they had realized that, hey, he no longer had his job, and they accelerated the note, took his cash out of the bank, really put him in a bad position for a period of time. So, I would just say, guys, when you're buying rental properties, kind of think of, how the bank is sort of collateralizing the loan. Sometimes it may be you and your wife or spouse, or you and a partner, or you and whatever, and they're considering a lot of different things, certainly a different topic, but that just triggered and reminded me that the loans are important when you're accumulating, multiple properties. Do you ever advise, and I know this is kind of like a specific question to maybe specific individuals' needs, but when do you recommend taking those profits and buying down the note versus buying another property? If you're looking at, you can make X amount of percent on the return of an asset, where is that line sort of defined?
Yeah, I mean it's a good question, and that's a tough one. I don't know. I mean, I think it's different for everybody. I mean, you've got the Dave Ramseys of the world that don't believe in debt at all, so they would say never buy debt or never get debt. For me, it's just a matter of is the return that I'm going to get by leveraging this asset, is it worth the additional risk? And that's kind of the way that I approach it. And the answer to that question is going to be different at different parts of your life, right? Like 5 years ago, I wanted all the debt in the world. And now, actually still today, I want all the debt in the world because it's cheap. And, we're probably going to be entering a period of inflation. So debt's a great hedge against inflation. My payments stay the same for 30 years. Well, guess what else doesn't? My income's going to increase. My asset values are all going to increase. So secured debt is a great hedge against inflation. So I want all the debt today. But if I have my parents, who are like almost retired, I don't want debt. I'm not going to go and refinance these properties unless the deal is unless I just find an amazing deal, which you're not really finding in today's market. So I don't want the debt. I'm probably focused on paying it down and just living off my cash flow. So I think it just kind of depends on where you're at in life and also how you view debt, because you could be anti-debt or scared of debt. And if that's the case, then I think that you need more education around debt before you load yourself up with debt. So, yeah.
Is there a percentage of debt on a specific property that you like to advise your clients? I mean, do you like to say, for instance, don't ever owe more than 75% the actual value of the property? I know a lot of people, then there's other strategies where, hey, if you have that extra 25% in equity, go ahead and refinance it, take it out, use that cash to reinvest.
Yeah. No, again, I think it's all individualized. Like I have personally bought property with 3% down and 30% down. It just kind of depends on the deal itself and what I'm hoping to get out of my levered returns, and what I feel like the market's going to do in that particular area over the next 5 to 10 years, which is my typical hold time. So no, and if something has a lot of equity, and if you have a lot of equity in property, you have to kind of get past the FOMO, the fear of missing out, right? Of, oh, this equity is burning a hole in my pocket, because it might not be. I mean, you might do a cash out refinance only to find that you can't actually find another deal to close on. So, the strategy that I would personally deploy, because I have a property that has a significant amount of equity now, and I've been thinking about this exact same thing, and I haven't cashed it out because the money is going to sit in my bank account and going to do nothing. But a strategy that I would deploy is if I were purchasing a new asset that was not just like a single family home or a duplex that's going to generate, a 12% return. if I'm purchasing an asset that is a little bit more aggressive, like maybe like a beach home or a wedding venue or something like that, that's going to potentially generate 15, 20, 25% returns. That's when I'm going to go cash that equity out, and I'm going to use that equity for part of the down payment or all of the down payment on that new property. So for me, it's like if I'm going to go through the hassle of doing the refi, through the expenses of doing the refi, through the increased risk of doing the refi, then I'm going to redeploy this capital into something that's going to earn a significant amount more than what my next single family home would earn. That's the way that I look at it. That's not the way that all of our clients look at it, though. They refi all the time, and it's just massive accumulation of properties. And you end up with like 50 properties, and you just start paying them off one by one. And that's a great way to do it too. You snowball your debt payments, but it's just individualized. Everybody's got a different approach.
So you just said something. You have a property that has considerable equity, and you're just enjoying that right now, instead of taking the cash and sticking it in the bank. And maybe one of the reasons is because real estate's at a high point, or that there may be, it's kind of a big question mark right now. Some experts say, hey, inflation's going to happen. Property values are going to continue to rise because property values follow inflation. Then there's the other side where the people that remember 2008 and say, well, if you buy right now, you're an idiot because there's going to be this major adjustment of 12 to 15%. No one knows. But doesn't that kind of same go for the 1031 exchange? I mean, if you had to just give some quick tips advising somebody on a 1031 exchange strategy, what would it be? Do you know before you sell what you want to buy because the window is so short?
Yeah, if you want to execute a 1031 exchange very well and not have to worry about it, then you put the property that you're buying under contract around the same time that you sell your property or have your property go under contract. So your closing dates should be relatively close together. You would sell the property that you have currently, and then like a week or two later, close on the next property. That's the most effective way to do a 1031 exchange. So you've already identified the property, you've already got it under contract. The rest is just executing that.
Have that step up property already sort of picked out before you sell? Is that what you think?
Yeah. I mean, ideally, if they're both under contract at the same time, that's perfect.
Yeah, because I was finding there was so much pressure. I'm a capitalist, right? I'm looking for opportunities. And one of the frustrating things, I started out, this is just me personally, I'd never done a 1031 exchange. In fact, I still haven't done a 1031 exchange. But basically what happened was, Brandon, I was finding myself like reaching in states that I knew nothing about. I mean, talk about how risky and dangerous that is. I mean, because I couldn't find anything in my market that was priced where I felt comfortable buying. And, that felt like a hammer just kept hitting me on the head every single day, that if I didn't identify this property, and then finally I called a friend of mine and he said, yeah, you know what? He has bought and sold a lot of properties. He said, I've actually never done a 1031 either. Yeah. And he said, I was getting ready to do one and I canceled it basically the same reason that you had said. So your advice, find that property, maybe even before you put yours up for sale, hope that you can secure it or work with the owners to make that happen. Yeah. Real quick, what about cost segregation? So, I'm bombarded by people that are saying, hey, you're in the real estate business, you do commercial real estate, I want access to your clientele, I want to talk about cost segregation. Again, I know very little about it. I'm looking at maybe doing it this year with one of my properties. Is there anything people should be mindful of and careful when they're doing something like this?
Yeah. So the first thing to be mindful of and be careful about is that a lot of the cost segregation companies employ 1099 contractors for their sales teams, and it's just a big sales push. So you should go in skeptical. Now, there's really good cost segregation companies out there, but if you're getting bombarded, then it's people that have quotas to hit, and they're just trying to sell you the next study. So that's when I say be careful. And a good example of this too is there was there's a couple cost seg companies out there that tell you that you have to have your cost seg done by 12/31. And that is not true. You have to have your cost segregation study done before you file your tax return. So for our 2021 tax returns, the deadline, if we extend, is 10/15/2022. So I can get a cost segregation study done on 10/15/2022 for my 2021 purchases, and I can add it to my 2021 tax return. That's the actual deadline. But they don't tell you that. They tell you that it's the end of the year so that they can meet their sales quotas. So the first thing to do is to just be skeptical, because they're trying to sell you something. And that doesn't just apply for cost seg, it applies for literally any business out there. You should always be a little skeptical, because they are trying to sell you something. Even if you contact me and my company, be a little skeptical, because we're trying to sell you something too.
Do you do cost segregation?
We do not do cost segregation studies. So we don't want the liability of the allocations, but we'll report the allocations that the third party creates. So cost segregation study. So if we go back to depreciation, right? Depreciation tracks the deterioration of your building over time. If I've got a $100,000 property, I have to look at that purchase price of $100K, and I have to allocate some portion of it to my land, because my land does not depreciate over time. It doesn't deteriorate. It's just land. It just sits there. So maybe I allocate $10,000 to land, and I allocate the remaining $90,000 to my building. If I do that, my annual depreciation should be $3,200 or $3,300 a year for 27 and a half years. Why 27 and a half years? That's what Congress came up with for residential real estate property. So you depreciate your building over 27 and a half years, $3,300, $3,200 a year in this example. A cost segregation study would say, well, the $90,000 that you allocated to the building, there's components within the building that are not going to last 27 and a half years. And the IRS gives us depreciation schedules that allow us to depreciate those components over a shorter time frame. Specifically, we have a 5-year, a 7-year, and a 15-year bucket or time frames that we can move value into. So what a cost segregation study does is it takes the $90,000 and it'll take $10,000 and put it into the 5-year bucket. It'll take $5,000 and put it into the 7-year bucket, and it'll take $5,000 and put it into the 15-year bucket. So now you have $10,000 in your 5-year life bucket. So you're depreciating $10,000 over 5 years. So that's $2,000 a year, right? Then you've got $5,000 in your 7-year bucket, $900 a year or so for 7 years. And then you've got $500 in your 15-year bucket. And I don't know what that is off the top of my head, $500 or something like that, for $300, $350. So now, between our 5, 7, and 15-year components, we're depreciating $3,200 a year, right? Right around that, right around $3,200 a year. But we also have $70,000 still in our 27 and a half year bucket, because we only allocated $20,000 to 5, 7, and 15-year components. We still have $70,000 being depreciated over 27 and a half years, and that's an extra probably $2,500 a year. So now our first 5 years of depreciation are going to be like $5,000 a year rather than $3,200 a year. So you increase your annual depreciation expense up front for the first few years. Because once we hit 5 years, then the $10,000 that was allocated to the 5-year property is fully depreciated. So the depreciation stops. So eventually you end up with lower depreciation annually, but you're just front loading that depreciation. Now, cost segregation studies have become way more valuable ever since the 2017 Tax Cuts and Jobs Act, because that act allows us to 100% bonus depreciate any component with a useful life of less than 20 years. So we go back to our example where we had a $90,000 building, but with a cost segregation study, we allocated $20,000 to 5, 7, and 15-year components. Then we can immediately expense the $20,000. So now in year one, I have $20,000 of depreciation expense from bonus depreciation, plus the $2,500 of annual depreciation I get from the $70,000 that was still on my building. So my first year bonus depreciation, or my first year depreciation, instead of being, $90,000 divided by 27 and a half, instead of being $3,200 a year, my first year is like 22,500. And that's going to create a large tax loss for you. And then whether or not you can claim that tax loss depends on how the passive activity rules apply to your situation. So a lot of people make the mistake of getting a cost segregation study done, getting this big tax loss, and going, man, I'm saving so much money on my taxes, only to find out that they can't actually use the tax loss because the passive activity loss rules prevent them from doing so. So you've got to get with somebody that understands the passive activity loss rules. The cost segregation companies do not understand this well. We have had to educate them on how it works because their sales practices sometimes don't align with the client's best interest. You can create this 100K tax loss, but if you can't use it, then it's pointless, right? Relatively pointless. So that's a lot of our consulting, again, is in the passive activity loss rules. We know it really well, but you have to change your facts and circumstances to make sure that you can use those tax losses.
So 2 questions. One, can it be utilized for commercial buildings as well?
Yep.
Great. And then the other question is, what if you're talking about, you didn't just buy the property this year, so you're not your first, tax year doing this cost seg. If you've owned the property for 5 or 10 or 15 years, can you kind of go back and recapture the cost segregation?
You can, yes. So you can cost segregate the property at any time. You can actually sell the asset and then cost seg it. So you don't have to, and there's different use cases for that, but you can cost segregate a property anytime that you want to. Now, whether or not you should depends on your individual facts and circumstances, right? So if you've owned a property for 3 years and you want to cost segregate it, cool. We can cost segregate it in year 3. We'll be able to claim in year 3 all of that depreciation that you missed by not doing it in year 1. So it's all the bonus depreciation, any of the other accelerated depreciation, plus my annual depreciation on the building. I get to claim all of that in year 3. And I file a specific form called Form 3115. It's a big form. You should not do that yourself. But and that might work. But if I've owned a property for 10 years, then I've got to do a little bit more thinking. I've got to do a little bit more analysis because it might not make sense to do the cost seg. It just kind of depends on the purchase date and what rules were in place at that point. So if you've owned a property that you want to retroactively cost seg, I would say explore it, but explore it with a competent advisor.
Guys, I mean, you have to see absolute value in this. If you're investing in real estate, you own rental properties, whether you're a W-2 employee working a full-time job or not. I mean, tax planning is very important. We have a real estate expert right here. Brandon, we thank you so much for giving us your wisdom, spending time with us. And guys, if you're looking for good, sound advice, tax planning, reach out to Brandon. Brandon, will they reach out to you directly, or is there somebody else they should speak with?
Yeah, the best way to contact us is to go to our website. It's www.therealestatecpa.com. We have all of our service information there. We include our prices as well, so you can go check that out. And if you're interested, you just click the big orange button that says Become a Client and fill out a form. Awesome. Thank you so much for being on our show. Thanks, Todd. I appreciate it. All right, guys. And until next time, we hope you receive great value. Check Brandon's information. All of his links are in the show notes. Brandon's got a YouTube page. Check him out. As always, we appreciate a thumbs up if you like this video. And guys, we appreciate you subscribing as well. Till next week, we'll see you later.